Welcome to the Deep Dive. Today we're jumping into the latest earnings call from JBT Morel, ticker JBT.
That's right. We'll be unpacking their Q1 results and what their leadership sees ahead, especially with the ongoing integration and, well, some economic headwinds.
Absolutely. For anyone tracking this merger or just the broader industrial tech space, this call had some pretty important nuggets. Let's start with the headline numbers.
Okay, so big picture. JBT Morel actually came in ahead of their own forecasts for the first quarter.
Ahead? In what areas?
Revenue, adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, and their margins were all better than they'd guided for.
That's encouraging. What about year over year?
Also positive there. Strong improvement compared to last year, both on margins and, interestingly, on orders, too.
Orders were up, despite everything.
Yeah, order demand climbed 12% year over year. And that's following what was apparently a record Q4 for them.
Wow, okay. So momentum seems to be there.
It does. And another key point, recurring revenue looked pretty solid.
Good, good. But there was a change in guidance, wasn't there?
Yes, that's a big one. They've actually pulled their full year guidance for now.
Pulled it completely.
Temporarily, yes. They're only giving guidance for the second quarter, citing macroeconomic uncertainty and the impact of tariffs as the main reasons.
Okay, so what are they guiding for Q2 then?
For Q2, they're projecting revenue between $885 and $915 million. Adjusted EBITDA margin is expected between 14.5% and 15.0%, and adjusted EPS around $1.20 to $1.40.
All right. Let's dive deeper then. What actually drove that better than expected Q1 revenue?
Well, a few things really stood out. That recurring revenue we mentioned, parts and services, was definitely a big piece of it.
Right, the steadier stuff.
Exactly. Plus, they seem to have had good operational execution, getting equipment shipped out the door.
And any specific end markets doing well?
Yes, definitely. They called out the poultry industry specifically. They see that as a continuing recovery, strong fundamentals, good long-term outlook there.
Poultry keeps coming up for them.
It does. But it wasn't just poultry. They said orders were healthy across other areas, too. Meat, beverage, pharma, even pet food.
Pet food. Interesting. And this was global strength.
Seems like it, yeah. They mentioned broad-based strength across their global regions.
Okay. And moving to margins, you said they improved. What was behind that? Higher sales helping?
That was part of it, yes. The benefit of higher volume flowing through. They also pointed to good expense control.
Standard livers. Anything specific to the Morelle integration?
Yes, actually. They highlighted improved profitability in the Morelle segment itself.
Oh, why was that?
A couple of reasons mentioned. One was a favorable mix, so more higher margin aftermarket sales and pet food revenue.
Ah, the mix effect.
Right. And the other factor was savings started to come through from their 2024 restructuring actions, plus some initial synergy benefits from the merger.
Okay, synergies. So the integration itself, how's that going? They seem positive.
The message was definitely positive. They said integration is progressing well, and importantly, maintaining continuity for customers.
That's key during a merger.
Absolutely. They've rolled out a new organizational structure too, focused more on end markets. The idea is to bring deeper industry knowledge to customers and, make it easier to sell the whole combined product range.
Makes sense. Are they actually winning deals that combine JBT and Morelle tech?
They claim they are. They mentioned securing orders, especially in poultry, that leverage the complementary capabilities, like offering seamless traceability across the whole value chain using both legacy systems enhanced with analytics.
Interesting. And the cost synergy targets, still on track?
Seems so. They reiterated the goals, $35 to $40 million in savings this year, aiming for an $80 to $90 million annual run rate exiting 2025.
And the longer-term goal?
Still $150 million exiting 2027. So they're sticking to those targets.
Okay, back to that guidance suspension. You mentioned tariffs and macro uncertainty. Can we unpack the tariff impact a bit more? That seems like a major factor right now.
It really does. They put some numbers on it. The estimated hit from current tariffs before any mitigation is around $50 to $60 million annually.
Wow, that's significant. How does that break down quarterly?
About $12 to $15 million per quarter. And that includes costs for both imported parts and finished equipment.
So what are they doing about it? Can they offset that?
They believe they can offset a good chunk of it. Their goal is to cut that quarterly negative impact by more than half for the rest of 2025.
How? What are the strategies?
It's a multi-pronged approach. First, leaning on suppliers for concessions. Second, some select price increases where the market allows.
Passing it on.
Where possible, yeah. Also, shifting sourcing reallocating demand to domestic suppliers, finding new U.S. suppliers,
Bring it onshore.
or manufacturing more themselves. They mentioned potentially increasing in-house production make versus buy at their U.S., Brazil, and maybe even India facilities.
Brazil, interesting, using their global footprint.
Exactly. Repositioning assembly, changing where parts come from, leveraging plants in the U.S., Europe, and Brazil seems key to their plan. They sort of framed it as, well, this might just become the new cost of doing business.
A new normal, perhaps. What about their overall financial health? With the merger debt and these headwinds,
They painted a pretty solid picture there. Leverage ratio is down to 3.8 times. And actually, under their bank agreement, which includes run rate synergies, it's lower at 3.2 times.
okay, manageable. And liquidity.
Plenty, it seems. Around $1.3 billion available. So, good flexibility. And they're confident they'll get that bank leverage under 3.0 times by the end of 2025.
Right. Now, that strong recurring revenue you mentioned earlier, how sustainable do they think that is, especially if customers get nervous about, say, tariff-related price hikes on parts?
Good question. They noted parts orders were strong in Q1 even before all the tariff details were out.
So maybe less price sensitive?
Possibly.
Yeah.
Their view is that food production is essential, so demand for parts and service should hold up reasonably well. But they are considering adjusting parts pricing to reflect those higher import costs.
How many parts are affected by imports?
They said somewhere between a third and maybe half of their parts inventory, so it's not insignificant.
And what about the equipment already in their backlog? Can they reprice that if costs go up due to tariffs?
That's tricky. They said about 40% of their revenue is U.S. based, and maybe 15% of the backlog is parts and refurbishments, less affected by the equipment tariffs.
Okay.
For the actual equipment backlog, repricing is being handled case by case. It really depends on the specific customer contract terms.
So some might be fixed price, others might allow adjustments.
Exactly. But they made it clear that any new quotes going out now will definitely reflect the current tariff situation.
Makes sense. You mentioned specific markets earlier. They talked about fish, I believe. How's that looking?
Yeah, a bit mixed there. The white fish market is still challenging. Quota reductions are hurting volumes, like a big 25% cut in the Barents Sea.
Ouch. Any bright spots?
Well, potentially. There's growing investment in whitefish farming, like cod farming in Norway. That could be an opportunity down the line.
And salmon?
Salmon looks better. Biological issues are apparently easing, which means lower prices, boosting demand, and leading to more production growth. So, some recovery there.
Okay. What about their digital side? Software, analytics, is that driving much yet? Did it contribute to that high recurring revenue number in Q1?
Not really, according to them.
Yeah.
They said the over 50% recurring revenue figure in Q1 was mainly down to seasonality in how they recognize equipment revenue.
Ah, timing.
Yeah. Software and digital revenue didn't materially change quarter over quarter, but they sound quite excited about combining the software assets.
Combining Morel's and JBT's offerings?
All right, Morelle has this soft line software for like overall plant efficiency, while JBT's OmniBlue is more focused on optimizing individual machines.
I see. So connecting those up.
That's the plan. They're in the early stages of integrating them. They expect revenue synergies from that.
Yeah.
Eventually. Not quite yet, though.
Okay. One last thing on the integration, doing all this amidst tariff uncertainty and potential macro slowing. Does that add risk to hitting those synergy targets?
It's a fair point. On the cost side, things like SG&A savings, logistics, they feel those integration efforts can continue pretty much regardless of demand changes.
Because those are internal efficiencies.
Exactly. They have a history, they say, of reacting to demand shifts with continuous improvement anyway. The potential risk, maybe, is more on achieving savings from, say, combined purchasing power for raw materials and parts if overall volumes were to drop significantly.
Right. Volume discounts might shrink.
Potentially. And, shifting manufacturing footprints around because of tariffs could complicate the integration process a bit. But they emphasize their flexibility, having plants in different regions.
Like Brazil again.
Yeah, Brazil seems to be a key strategic piece for them, offering flexibility if they need to shift supply chains significantly. They even framed the tariff situation as a potential opportunity relative to competitors who might not have that global scale or flexibility.
Interesting angle. Okay, so wrapping this part up, what's the key takeaway for investors listening to this? What's the context?
Well, first, that guidance suspension is definitely a flag. It highlights real near-term uncertainty about tariffs and the economy, which is, a primary concern.
Can't ignore that.
No. But on the other hand, you have the strong Q1 performance and pretty solid Q2 guidance, suggesting the underlying business and the integration efforts are actually going reasonably well so far.
So near-term fog, but maybe a decent engine underneath.
That seems to be the picture. They're proactive steps on tariffs, leveraging that global footprint that could be a differentiator. And that strong recurring revenue provides some resilience.
Plus the long-term focus on growth areas like poultry and integrated solutions.
Exactly. Those remain positive signals for the longer term, assuming they navigate the current turbulence.
All right. That brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea stemming from this call. What have you got?
Okay, so leaning into that Brazil angle we discussed, JBT Morel is clearly highlighting their Brazilian manufacturing base as a way to potentially bypass tariffs and serve global markets.
Right, using it as a global hub.
Potentially, yes. So here's the outrageous idea. What about taking a long position, not directly in JBT, but in Brazilian industrial real estate? Specifically, maybe an index or certain REITs focused on key manufacturing areas in Brazil.
Betting on increased FDI and manufacturing shifts to Brazil.
Precisely. If JBT Morel and maybe other multinationals start shifting more production there to avoid tariffs elsewhere, you could see increased demand for factories, warehouses, logistics centers. That could boost those industrial property values and REIT performance.
Highly speculative, obviously. It depends on trade policy, Brazil's stability.
Oh, absolutely. Very speculative. It depends heavily on geopolitics, execution, the Brazilian economy itself. Not for the faint of heart.
Okay, trade idea number 2.
Second idea focuses on that recurring revenue strength and the tariff pass-through potential. Consider a long-short strategy within the broader industrial equipment sector.
How would that work?
You'd go long on companies like potentially JBT Morel that have a high percentage of recurring revenue and seem able to pass on costs, maybe because their parts and services are essential.
Okay, long the resilient ones.
And then you'd short companies in the same sector that are maybe more reliant on new equipment sales, particularly in tariff-sensitive regions, and might have less pricing power to offset those costs.
Interesting. Pitting the service heavy against the equipment heavy, factoring in tariffs.
Kinda. It requires really deep knowledge of the sector, individual company balance sheets, pricing power, supply chains. It's complex. But it plays on the themes we heard today, resilience versus vulnerability in this environment.
2 very different thought-provoking ideas there. Okay, that wraps up our deep dive into JBT Morel's latest earnings call. We've hit the financials, the strategies, the tariff talk, integration progress.
And hopefully giving you a clearer picture of where things stand. Just a reminder, of course, everything we've discussed is for informational purposes. It is definitely not financial advice.
Absolutely. Please do your own research, consult with professionals before making any investment decisions based on this.
So what stood out most to you from the call? Any lingering questions? We really encourage you to dig into the company's filings yourself and see how this fits into your own investment view. Feel free to join the conversation online.
Thanks for tuning in to The Deep Dive.